So as a continuation from last week, mortgage consultation, real quickly here, pop quiz. I won't pick on anyone. What are the 4 major areas of qualification that you guys should be discussing in your consultation with your clients?
Debt. What's the last one?
Debt, credit, yep. Assets. Very good. Very good. That is a must. Okay, those 4 things. If you guys are not touching up on those 4 areas of qualifications during your consultation, you are gravely failing your client, yourself, and your team, and the insurability of closing that file. Okay, because it is your job as a mortgage professional to know those things. Okay, it's not your processor. Your processor is not calling them and saying, "Hey, let me tell here," and they don't have the time. Nor should they. Right? Their job is to understand the story that's provided up front, or the profile, right? The characteristics of that file. And really their job is to do the mechanical work, right? Tax returns, pay stubs, W-2s, bank statements, all align and fit the narrative of this profile. It looks good, it's supported, let's move it on up into underwriting and review, and ultimately into funding. Very good. Harrison, and thank you, Harrison. And if you guys have it, again, I'm not going to push this. Okay. You guys want it, you do it. He has it. But he did a great job, few minor changes to it. So let me go ahead and share that with you, as I will be referencing this today for the second part of our training today. Here it is. Personally, I think it looks better than the previous one. Is it not showing up?
No, we can see it. We can see it.
Okay. There it is, guys. And thank you, Harrison, because my God, that handsome young man in the bottom left looks like 50 pounds less than I weigh. I look like I have a waistline there. But yeah, got color schemes, right? Kind of fitting Giving Tree Lending, my information there. Again, this can be easily done for you guys as an MLO. Get it done before the end of the year, please, if you want to get with Harrison. Yeah, here's a mortgage cheat sheet. I'll be kind of referencing this, so if you want, I'm going to keep this up. Okay, as we continue. So today, what are we going to go through? We're going to kind of go through completing the mortgage, completing the mortgage consultation, right? I want to take you guys through what I do. And then hopefully, it's of help to you guys. Okay, so I'm going to bring up my notes here. Okay, so when it comes to the consultation, guys, I know everyone has a different style. Okay, so please, adjust it according to yourself, how you want to go about it. But how I go about it is, I will say, Cindy, how familiar are you with how the mortgage process works and what mortgages even is? And Cindy will probably say, oh, this is my first time, I really don't know much. And I set the stage here and I say, hey, let me take 60 seconds and just give you a quick historical perspective of what mortgages. And the reason why I do this, guys, is because you don't know what kind of loan program you'll ultimately may have to evolve into. Okay, up front you might just thinking, FHA or maybe a conventional, right? So I'll say something like this. I say, so right, Cindy, you know that there was 2008 there was a mortgage crash, right? The housing crisis. Yes. Yeah, well, that kind of changed the direction of mortgage landscape in America. So President Obama and his administration, I don't say that all the time, but the administration at the time passed what's called the Dodd-Frank Reform Act. It is one of the largest reformation acts legislations that was ever passed in the history of the United States, about 1,700 pages. And in that legislation, there's a section called qualified mortgage. Qualified mortgage basically outlines and sets forth all these guidelines through the FHFA. And honestly, part of this, guys, is just for me to sound intelligent. And I'll be like, you could fact check this, you could Google all of this, and it'll come up, because it will, okay? But I go, so there's qualified mortgage, and basically what it is in a nutshell, for you to know, to understand, is In order for a prospective buyer to qualify for a mortgage, they have to meet the ATR rule, the ability to repay. How the ATR rule gets quantified or qualified is through the DTI. So if you do a lot of research on mortgage, they're going to talk about the DTI ratio, the debt to income ratio. And it's just simple elementary math. It's all your total debt divided by your total income. That's it. Really easy. Do you have any questions so far, Cindy? No. Okay, great. Now this is where I use that as a transition into the 4 major qualifications of mortgage, right? So I'd say, hey, Tariq, now that I kind of gone over like the historical context of what mortgage is, mortgage, it really isn't rocket science, right? We went over this last week, right? There's basically 4 areas of qualification, right? And then I'll go through that, right? So you see the mortgage cheat sheet, right? So here, each section has a little bit of everything. It has, you really have to read through it a few times to understand it, but it has like the guidelines as well as like the documentation that's going to be needed. It's all just kind of jumbled in there. Could I do, if I really spent some time, could I clean this up a little bit? Sure. But again, it's more for reference for me at this point. And at this point, I don't even really use it because it's I have it all memorized, right? So like for credit, guys, right? School loans. Do you guys know the rules of school loans? Right? So many a times because of forbearance and whatnot, when you pull the credit report, you're not going to see a monthly payment. But you guys all do know, right? Because most people will say, oh, but my school loans, they're in deferment. I don't have a payment. You as a loan officer, can you qualify using $0 on school loans? Right? No, right? Thank you, on. No, you can't. You have to hit them for a payment. Whether that's FHA, VA, Jumbo, Fannie Mae, Freddie Mac, non-QM, you can't qualify a client because they said, oh, I don't make any school payments. I haven't made them for the past 5 years, and I'm not going to be making them. Doesn't matter, guys. You have to hit them for a payment. So that's why I have that on there. Depending on the program, it's going to be 1%. In some cases, it's going to be 0.5% like Freddie, okay? There's also waiting periods. Like you get the credit report, you pull it, and you notice, oh my goodness, there's all these like foreclosures and stuff or whatnot, bankruptcy. Hey, pause, boom. We can't do agency conventional loan here. We have to go non-QM if that's the route they want to go. We have to, right? So the top bullet point there really is, this is just a rule of thumb for me. This actually changed when the LLPA changed in 2022. Do you guys all remember, the colorful chart that was being blasted on social media when the credit report change happened, or how credit scores and down payment changed interest rates? Do you guys all remember that or no? It was a huge, huge mover in the industry. You guys remember seeing this? Okay. So basically what this was, guys, was for the most part, if you had a 740 or better FICO score, you're going to get prime pricing, right? That's kind of that was really the gist of the pricing back then. And of course, the down payment would affect it in the property type. But now, as you can see, every 19 points, okay, it affects your pricing on the interest rate. That's what these colors are. That's why it's different everywhere. Now, we can study this, and that's going to be for another training class, because we can kind of really dissect, hey, wait a minute. If you have a lower FICO score and you're doing less down payment, you actually benefit, right? So this is a whole nother class in of itself that we won't focus on today. But the bottom line is I just wanted to mention that this rule is kind of outdated for me, or it is. However, it still is applicable. Okay, so if you get a credit report, or if someone tells you during your consultation, hey, Ragnar, I think my FICO score was like 660, guys, honestly speaking, more probable than not that you're going to go with FHA, okay, and not conventional. And you won't want to just take a wild guess why.
there's something that's driving that lower score.
Correct. Yep. Now, more than the interest rate. Now, if I just said something, right? FHA. So you're assuming that they're not going to be doing 20% down payment, right? So what else is going to be affected with the lower FICO score that may not make the conventional attractive?
Monthly.
The MI premium.
Boom. Bingo, Steve, right? Because remember, even with a 620, 640 FICO score, your on an FHA program, your PMI is still 55 basis points, guys. That doesn't change whether you have 800 or 640. But on conventional, guys, remember, with the lower FICO score, you can go from easily a 24, like 14, 24 basis points on PMI to like quadrupling it to like 100 basis, 90 basis points. In some cases, it can even be over 100 basis points. So now it is considerable. Now we're not talking $200-$300. We're talking $400, $500, $600 now, right? So again, that was according to the older rule. There are some considerations there that might not be the case, but for the most part, it's just a barometer for me in my head. What am I working with here? 620 FICO score or a 780 FICO score? Okay. Right. And so you guys can kind of go through this. So we've already went through this last week. So I'm going to really stop there. Now kind of moving on to stop sharing. Sorry. Moving on to the consultation. So, right, we get into the 4 areas of consultation, 4 areas qualification, and then I will basically break down. So usually the question that comes up is like, how much do I qualify for and what kind of program am I going to go into? I really just tell them, I simplify it, guys, okay? I just really tell them there are 5 major mortgage programs in America, and that's it. Right? Because on social media, they're being bombarded with nursing program, hero program, doctor's program, this program, that program. We got a program for you, right? And I just dispel all of that right away. A lot of it calms them. They go, oh, okay, I see. Wow, that's a lot easier. Thank you. Man, when you get that that's an affirmation from them to you saying, Ragnar, I trust you. I go, okay, there is what's called the conventional agency program, Fannie Mae and Freddie Mac, that makes up about like 60% of the marketplace, right? And then there's a government loan programs, FHA, VA, and USDA. If you're not a veteran, I know you're not going to buy in the agricultural like farm area, so that doesn't even apply. And then it's the jumbo loan programs, and I'll break it down for them based on the loan amounts. Again, remember the loan amounts, so you need to know your loan amounts, okay? Because remember, every county is different, especially when it comes to FHA and the government loans. Okay, so get yourself familiarized with the on that cheat sheet in the middle. There are the new loan updates. Get yourself familiar with it. So I talk about jumbo real quickly, which I kind of steer away from, guys, to be honest with you. I think here being at Giving Tree, I think I've done maybe 1 jumbo loan and that's it. Okay. And then I talk about DAP programs. Okay. And I say, hey, it's like 4.5 because DAP programs work in conjunction with the FHA or the conventional loan program. And then non-QMs. So non-QMs I kind of set aside and I park. I don't go into it. And usually I'll know if I need to go into it because I parked it because of the 4 areas of qualification. Right? Because why? Can anyone tell me what's going to tell me that need me to consider going into non-QM for these clients? What area of qualification? Alex said something, but I couldn't hear you.
Income?
Bingo, income, right? If they tell you you're self-employed, right? I park non-QM, the back of my head in my notes, I write down, and I go, okay, I might have to go into non-QM because they're self-employed. And by then, I've already dug into it, right? Oh, what do you do for a living, right? I don't know if you guys saw that. Here, I'll share it again. In your consultation, you need to be most thorough about income, right? How long have you been at your employment? Or do you have a 2-year history? Because you're going to ask for tax returns, right? So here, right? Self-employed 2-year average, okay? 2 years tax returns and business right here at the very top, right here. So you're asking these questions so that you can prepare yourself for having to pivot from conventional to non-QM, okay? Okay, so right, we go into non-QM. From there, I go, look, for the most part, 75% of the times, guys, right? You're most likely, again, unless you start changing your business plan for next year going non-QM, you're going to be working with conventional or FHA, right? So you kind of ease them into knowing, hey, it really comes down to Fannie Mae or Freddie Mac product or FHA product. So now you're just really focused on that, right? And it's easier for you too, right? So that's how I kind of get them into it. Again, I won't pop quiz you here. I'll wrap it up with them saying, hey, this is the programming we might want to best consider. I really don't go over what the amount, the interest rates, since I don't talk about interest rates until after the fact. They ask, I'm like, look, we got to sift through more first. Why don't you apply? Okay. If they keep pushing the agenda on it, then I say, look, this is the range, but look, I want to assure you. And this is usually where I now plug Giving Tree. Okay. So when the client keeps pushing rates, okay, again, because this whole time I'm not really talking about rates. Okay. Not once did I mention a quota rate. This is where I will say, hey, I'm going to take an opportunity to just tell you why, you should be working with Giving Tree. Okay. And I'll go through the whole spiel. And it's a little bit exaggerated, but for the most part, it's true. Right. So I'll say that